Thank you so much all for joining. And let me start. 1 second. Okay. Well, I think let's start formally. Sorry that everybody had to kind of wait on me. My name is Prashant Kumar. Some of you have known me on internet. I talk sometime, on Facebook Lives and stuff. And every week, every alternate week, we try to do a webinar, and in that webinar we try to invite a guest speaker, try to bring interesting people online here so that we create some value for listeners. And we really appreciate those who are here today, who are watching us in the live, or those who are watching our recording. We are very appreciative of your time, and we hope that we are creating value for you through this webinar. Just a little bit about myself. I wouldn't take too much time, and then I will introduce my friend Badri, whom I met only a couple of months ago, but whatever he's doing extremely well. So I'm going to discuss about him. Just a little bit about myself. I am into we are a syndication, multifamily syndication company. I have a strong technology background, and basically due to that, I'm able to do a lot of syndication. I'm able to create some value for our investors by analyzing these deals. And in the last 1 year itself, we did about 1,200 units in multifamily. This year, for obvious reasons, we are not doing so much. But besides multifamily, multifamily has become so competitive. Besides multifamily, we are looking at other asset classes also, like assisted living or mobile home parks, storages, that. So that's just a little bit of my background. In addition to that, I have created a 7-day passive email course for our investors. Feel free to subscribe to that, and I will share all those links with you guys. My basic purpose of doing it is to free myself. I mean, whatever we are doing, if we are working in a corporate world, we are trading money for our time. The real purpose for me to come into real estate was to actually get out of this rat race, and I must say that I'm kind of out of it. Uh, for last 6 months, 8 months, it was completely out of it, and I'm enjoying that life. I would love to share what I did with others, and the purpose. And for that reason, I created a small course for friends, those who want to know a little bit about passive investing. My website is myrealtygains.com, and 7-day email course, 7-day email course. Subscribe to that. It takes 1 minute. You want to talk to me personally, feel free. You have my calendar, myrealtygains.com/schedule appointment. In addition to that, I have my contact details, Prashant at myrealtygains.com. And I wouldn't take too much time. I'm going to stop now, and I'm going to introduce Badri. Basically, give me just 1 second. So I met Badri a couple of months ago, right, Badri?
Yeah, so I think it's been a couple of months. Time flies by, but I think we met each other in other events, right? I mean,
Yes.
Raising capital and things like that. Yeah. So
yes. So Badri has been into financial market, and he has done a lot of work, in funds management and options, and he's an angel investor also. He tries to invest in some tech companies. Currently, he's working with Avestor, the company who has created a portal in which they are creating the alternate ways to invest into different assets, not creating a huge amount in one asset. And I'm going to let Badri explain it. I don't want to steal his thunder, but Badri, I forgot to bring your resume in front of me. I was going to
no worries. I'll briefly talk about it. Yeah.
So please introduce yourself also a little bit. And I was very impressed with what you guys are doing, and this is the reason why I invited you to be able to create value for our investors. So,
Thank you.
Badri, you can start now. Okay.
Okay. So if you don't mind, I'll stop. I'll take over screen sharing. So
Yeah, please. Yeah, please. Yeah, I'm gonna stop sharing, and then yeah, you can. Yeah,
okay.
all yours.
Okay. All right. Hey, welcome everyone. As I indicated, my name is Badri Malynur. I'm a co-founder of a company called Avestor. So this is really more of an educational talk, and we'll conclude with a short demo of Avister and the value prop we bring. So I've been in I do a variety of investments, as Prashant said. I left the corporate world almost 10, 12 years back. I'm an angel investor, invest in venture funds. I also used to run a hedge fund. I exited a couple of startups. So I have a broad background. So I would like to request that you mute yourself. I hear somebody talking, so thanks. Okay, so what this talk is all about. So here's the strange thing about this talk. There'll be something which everybody knows, but I'm hoping that collectively it'll be useful to you. I'm sure some of these concepts are already familiar to some of you, but maybe there are some concepts you're not which is not familiar to some of you. And then we'll go from there. So meanwhile, before I get started, how familiar are you with the crowdfunding sites? Maybe people can, like CrowdStreet and so on. Maybe you can just type in the chat message. I'll take a look. And do me a favor, Prashant, while I'm engrossed in the talk, if somebody asks me a question, I might not see it.
Yes.
But if you could,
okay. That's good that you have mentioned it. Yes, I have the chat window open, guys.
Okay.
Feel free to ask any questions in the chat window, and I'm monitoring that.
Yeah.
And
I'll try to look at it too, but sometimes if I just get involved in the talk,
that's my job. That's my job for now. So
there you
feel
go.
free. Focus on your.
Let me go ahead and get started. And most of you may be familiar with building a stock portfolio, and it's not that hard to do. A bond portfolio, a little harder, but you can still do it. But have you ever thought about how you go around building a real estate portfolio with a limited amount of money? I mean, I'm not talking about if you're Bill Gates or Elon Musk, but that's kind of what this talk is all about. What are the factors you should consider? So let me move the screen on to this side. So building a real estate portfolio is pretty hard, right? I mean, you want to start from the left to the right. And since you're attending a real estate talk, I'm not going to convince you that adding real estate is a good thing. We'll just take that as a given, yeah? It helps you diversify away from the volatility of the stock market, and it hopefully will zig when the stock market is zagging, right? There are significant capital requirements. You'll have to find the opportunities. Some of the deal structures are complex. You have to manage the risk. And most importantly, when do you exit, right? I mean, syndication deals like what Prashant is doing is an excellent way to do it, but you still have to evaluate a lot of deals. So what I'm going to talk about is the different types of real estate deals. And as I indicated, some of you will be familiar with some of this, but hopefully not all of it. A brief description of accreditation. Since you have invested in Prashant's deals, you're probably already familiar with that process. What are the top portfolio considerations you have to look at when you design a real estate portfolio? And then how do you use crowdfunding to accelerate your portfolio building? And then some final thoughts, yeah? So what are the different ways you can invest in real estate? I mean, guys, I know some of this is obvious, but let's kind of go through it in case some of you are not familiar with some of the options. You can obviously purchase individual properties, and that's one of the most common ways of doing it. You can invest in equity deals, which is either crowdfunding deals or the syndication deals, which I'm sure you have listened to on a number of seminars and webinars. You can invest in private REITs or private funds, or you can invest in debt deals where you're actually lending money to somebody. And I would like to briefly talk about each one of these options, yeah? So the direct property purchase, I think, is what I think most people are familiar with. You purchase a second home or a small multifamily unit. I don't know, you put 25, 30% down, 20% down, the remaining is a loan, but then you have to manage the property or become a property manager or hire a property manager. You get passive income and appreciation. The good thing about this is you can exit on your own timing, right? I mean, you can decide when you want to exit and you're not beholden to others. And you make all the decisions. And the beauty of this, of course, is the renter is paying your mortgage off and you get all the tax benefits of depreciation and write-off expenses, right? So, but here are the cons. Significant cash down, you have to manage the property, there is no liquidity on invested capital, and you're in a single market. I mean, unless you can buy a single family house in 50 different states, your risk is tied to a single market, right? I mean, I think a lot of you guys are already familiar with the pros and cons of this. So then you can also invest in private REITs and public REITs. So I don't know how many of you are familiar with the real estate investment trusts. I mean, that's one of the easiest ways to get into real estate. There are things like Simon Property Group, which invest in retail units, and then Public Storage, which invest in storage units. The main advantage of this is it has high liquidity, very easy to research, and you don't have to invest a lot. You can buy a stock for $100 or $500 or whatever, right? But here are the cons. You get a small slice of a big pie, and sometimes you don't even know what are the ingredients in the pie. There is very little transparency. And if your goal is to be not tied to the stock market, well, this doesn't accomplish it, right? Because the public thing trades like a stock, and the average rate is still down 30%. And during the COVID crisis, it was down 60 to 70%. And the dividend payouts typically are 1099s. Very few REITs give you a K1, so you don't get many of the benefits of depreciation which you get from a real estate, right? So, and then in private REITs, you can either go through a broker or you can go directly. These are exempt from SEC registration. The main advantage is they're independent of the stock market. You have a little more transparency on the investments, and you have access to deals which are not available in public REITs. And all of these are packaged in a limited partnership structure, which gives you the benefits of depreciation. And it does require a fair amount of research, and there is less liquidity in these REITs, right? So, and then these equity deals are the kind of deals which I'm sure Prashant has talked to you about. And these are the syndication deals. Being a passive investor, you can get into larger commercial deals like apartments, offices, hotels. Somebody like Prashant is the general partner. Investors are generally passive and receive equity stake, and you share in the income and profits. It's a way to own a stake in a commercial property, which most people cannot afford to buy by themselves. And you get 13 to 25% IRRs and passive income depending on the type of the project. If it's a new construction project, you may not get it. And you get the tax benefits of owning real estate directly. And the con is, for many of you, it may not be a problem. You have to put $25 to $50 to $100,000 per deal. And there is not much liquidity, right? I mean, you have to wait for 3 to 7 years. The GP has full decision authority, and you don't have the first lien. The lender has the first lien, and there is a possibility that you could lose all your money. I mean, it's if you choose a good syndicator, you'll be fine, but there is always that risk involved, right? So, and then these are deals which not as many people are familiar with. I mean, how many of you are familiar with, how many of you do hard money loans or debt deals? Just, I mean, if you could just respond. So here, what people do is you lend money to fix and flippers, right? So there may be small and medium-sized deals. There can be single and multifamily. The borrower is seeking some short-term capital. I mean, the banks typically frown upon, it's very hard to go through all the paperwork to get it. Generally, the notes are first lien. Sometimes you have second lien on the property. So, and then the main advantage is these are all short-term investments. 6 to 18 months is typical, 2 to 24 months. You get about 7 to 12, 13% return. And there you have downside protection, especially if you do the first lien. If something goes wrong, unlike the equity deals, the syndication deals, you have the first lien. And as long as you choose loans which have where the borrower has put at least 15 to 20% down, you're relatively safe unless the market crashes 20, 25%. The cons again is do you really feel comfortable? There are some crowdfunding platforms where you can do small loans, but if you go do hard money loans directly, you have to put up $50,000, $100,000, $200,000 per loan. And unless you know the person, you may feel a little less comfortable. And the foreclosure process can tie up the capital for more than 24 months in a worst case situation, right? So that's the pro and con. So I'll pause for a second. Any questions on the website? On the chat window? Nothing so far, right, Prashant?
Nothing so far, right?
Okay.
So please, please go. I think folks are familiar with some of these basic concepts.
Some of these concepts, yeah. I'll go a little, hopefully some of the other things may be a little more interesting.
Yeah.
So the SEC regulation and accreditation, I briefly want to mention this. So the SEC has a very broad definition of security. It includes participation in any profit sharing arrangement. And so the deal generally must be registered unless you can get a Reg D exemption. And most real estate offerings use these SEC exemptions, the Reg D exemptions, right? So, and the accreditation, again, folks, you may already be familiar with this. You have to have an income of $200,000, or if you're single, or 300,000 as joint, or your net assets should be worth more than $1 million, excluding your primary home. And the third-party accreditation services are there, or a CPA or a CFP can provide the accreditation letter. If you're investing as an LLC or a partnership, then all members must be accredited. Yeah. So just a quick recap of accreditation in case you're not familiar with it, but I think the people in this audience may already be familiar with it. Yeah. So here, what are the top portfolio considerations? I told you we'll talk about a real estate portfolio. So you need to first think about the structure of the portfolio. How are you going to allocate different pieces? Are you well diversified? How do you go about selecting your deals? What's the cash flow which you're getting?
Just one question which John has. How about 506B?
Yeah.
So 506B is an offering, John. 506B or C are offerings, but accreditation is for an investor, right? So 506B has certain criteria. 506C can have only accredited investors. 506B, you can have mix of accredited investors as well as investors with whom you have prior relationship. So that's like two different things. Accreditation is for investors, and Reg D classifications, 506B versus 506C is for the deals.
Thank you, Prashant. And the only one of the disadvantages of 506B is, of course, you cannot advertise as a syndicator. So you have to work with only people you know, or it has to be word of mouth. You can't advertise publicly. So Avister, for example, we decided to go the 506C route. I'll talk about Avister a little later. Yeah. So you again want to look at the liquidity, and then you want to make sure you're structuring your entire portfolio to maximize tax benefits. I'll go. I know this is all high level, 10,000 feet. I'm going to go into each one of this in a little more detail. So what do I mean by a portfolio structure? Okay. So first of all, you have to decide. Now, I've told you, I've invested in almost every asset class, hedge funds, Bitcoin, digital currencies, angel investing, real estate, options, commodities. You have to decide. Real estate is considered an alternative investment class. You have to first decide what's your net worth and how much do you want to invest in real estate. By no means I would recommend you put everything in real estate, right? So if you have $1 million net worth, you may want to put 10, 15, 20% on real estate. It depends on your risk tolerance and your preference. So, okay, you take 200,000, what can you do? This is simple math, right? You don't need a Harvard Business School MBA to do this. You could buy a couple of individual properties, $100,000 cash and remaining debt, or you could buy 4 private funds at 50K each, or you could do some syndication deals, 8 syndication deals at 25K each, or you could do some debt deals where you could go to some crowdfunding platforms and do about 5K each and do 40 different deals. So here is the main point I want you guys to think. I want you to think of, which deal should I buy? I want you to transition to how do I build a real estate portfolio that balances risk and returns? By all means, I'm not saying don't buy that first syndication deal or the second deal or the third deal. But as you build these deals, even when you're buying the first, second, or third, I want you to think 4 or 5 years from now or 10 years from now, where do you want to be? I mean, think of the journey. I mean, make sure that think of it, this is like a jigsaw puzzle, if you will, right? You want to make sure the puzzle is complete and you want to have the visualization of the puzzle. When you guys I don't know how many of you do jigsaw puzzles, you just don't randomly put pieces together, right? You're trying to say, hey, this is the overall vision. Where do I want to go? That's extremely important when you build a real estate portfolio, yeah? And you want diversification, right? Just like a stock portfolio, you don't want to put all your eggs in one basket. Now, New York, New Jersey may be a great area, depending on your perspective, but you really don't want to invest everything in the East Coast or a particular state, right? You want to invest in multiple markets. For example, here is an example of real estate prices. I mean, it's pretty obvious. You can see all the markets don't go in sync. I mean, for example, Durham was pretty flat. Portland, Oregon was hot, and then it came down, but there are different ebbs and cycles. I'm stating the obvious here, right? So in diversification is key in multiple markets and different types of real estate too. Like, for example, Prashant does assisted living, there is self-storage, there is multifamily, there is student housing. You really want to try and put your eggs in multiple baskets, right? Because different asset classes do differently. And then deal selection is very important. I mean, when you look at a single property purchase, you look at the track record of the renter. Do you have enough debt cash flow to service the debt? Obviously, the specifics of the property, the location, price, and all that. In debt deals, it's a superset, right? I mean, you look at the track record of the borrower, and you want to invest in states where the foreclosure process is fast. So there are some states where you have to go through a judicial process. You don't want to invest in those states. I mean, if you Google, you can see which states have judicial processes. I mean, I don't want to get into a political discussion, liberal versus conservative, but I'm sure as far as your money is concerned, you want your money back sooner than later, right? Regardless of your political affiliation. So, and then in equity deals, I'm sure Prashant's course talks about all of this. You have to analyze the capital stack. Is the deal investor friendly or is it sponsor friendly? I mean, hopefully the deals are balanced. What's the track record of the sponsor? How many years has he been in business? What kind of deals has he had exits on? You look at all of that, right? So you look at all of this when you analyze a deal, and you should research each deal thoroughly to minimize risk. I mean, I'm stating the obvious here. And then the other thing which is important is you need to look at your cash flow. Again, it's not for one deal. I mean, every deal will not have cash flow, but you have to look at it collectively and decide which does this cash flow meet your needs, right? If you purchase a rental property, you put in some principal, you have some loan, and then, okay, blah, 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 blah. There is a monthly income. Hopefully that is greater than your loan. And eventually you you sell your property and get some appreciation. In a debt deal, there are two types. When you invest some principal, you can get monthly interest, or sometimes the money is returned only at the end of the debt deal, right? And then in equity deal, it depends on what type of equity deal you're doing. And I'm sure Prashant again talks about it in his course. In new construction deals, there may be limited or no distributions, but in value add, generally there is some distributions, and in new constructions, the distributions happen in later years. And eventually the syndicator hopefully sells it and you get some appreciation, right? So build your portfolio based on cash flow requirements is the point which I want to make, yeah? And then don't forget the tax implications, right? I mean, again, for people who are invested in a variety of things, if you do debt investments, they typically come in 1099 INTs, and you have to pay regular income tax. If you do equity investments like syndication deals, you have to do K1. I mean, you'll get a K1. And private REITs, it could be a 1099 div or a K1. And just remember that the interest income is always taxed at your current tax rate. And remember that IRS treats each K1 as a separate business, okay? So you cannot offset passive gains from one investment against another, but the way we have structured Avister, I'll talk about that, you can actually do that. So that's one of the big advantages of Avister. Even though you invest in multiple deals, you'll get a single K1. I'll talk about that in a second. And then equity investments in other states may require a filing in that state. You'll have to check with your CPA. And having multiple K1s, again, will add to tax preparation and cost time, right? I mean, TurboTax handles it fairly well. So again, when you build your portfolio, understand the tax ramifications of your investments. It's again, it's not, by all means, buy it, take your first deal, second deal, and third deal, but make sure that you understand the tax ramifications of the investment. Yeah. So, and so John, that's an excellent question. I mean, let me defer that question a little bit. So it's John is saying that you really should look at the standard deviation that goes into portfolio theory, right? We try to apply the principles of stock portfolio and bond portfolios when we build the portfolios in Avestor also. Let me address that a little later. Is a LLC required, Carlos? Can you clarify? A LLC is required for what?
I think his question is there an LLC requirement for doing an investment into different vehicles that you are sharing?
No, not at all. You don't need a LLC. You can invest directly as an individual investor. I'm sure you can invest in Prashant's deals as an individual investor. I mean, the deal itself is an LLC, but you don't have to invest as an LLC, if I understood your question. Okay?
Yep, that's what he's saying. Yep.
Okay. So let me talk briefly about crowdfunding. So basically, there are various real estate crowdfunding platforms. You have to understand all this came because of the Jobs Act. There are various online marketplaces. You can participate in larger projects. I mean, syndicators sometimes go to crowdfunding platforms, or some syndicators raise their money directly like Prashant does. And remember, but be aware, crowdfunding platforms, their goal is not necessarily your goal, right? I mean, your goals are not completely aligned. They are trying to raise money for investors, and think of them as a seller's agent as in real estate, right? So they are trying to raise money I'm not saying they're cheating you or anything, but be aware that their goal is raising money as fast as possible for the people who are raising money, yeah? And you need to assess the quality of deals. Please don't fall for pretty pictures and marketing materials. I've been on syndication deals where people ask questions like, oh, does this have a fountain? I mean, guys, look at the financials first. Let's worry about how it looks later, you know? So, and then definitely, I know it's, I mean, it's bedtime reading, PPMs, limited partnership agreements. Sometimes the devil is in the details. Please read through them thoroughly. Yeah. And don't go based on advertised returns. I mean, you can make small tweaks in your assumptions, and then your IRR shoots out of the roof. Yeah.
Yeah. No, continue.
Okay, have a question?
No, I think somebody unmuted them by mistake.
Okay, no worries. And then be aware that some of the deals may take longer than anticipated. So any exits are all estimates. They're not guarantees, yeah? Just be aware of that. So here are some crowdfunding options. For example, if you want to buy complete properties, you can go to Home Union and Roofstock. If you want to diversify into multiple commercial investments with a single investment, Fundrise and Realty Mogul are some choices. Fundrise especially is a decent choice if you're a non-accredited investor. But remember that disadvantage of that is one size fits all. You get a slice of a big pie and you don't know what all is in the pie, yeah? And you don't get any of the tax benefits of real estate depreciation because it comes through as a 1099 typically. Equity deals, you can go to CrowdStreet and Equity Multiple. Here you can invest in individual commercial deals like syndication deals. And you can do commercial debt deals in Fund That Flip and Patch of Land. And another one I would suggest is Ground Floor. In Ground Floor, you can invest as little as $10 per deal. And so you can get more diversification there, yeah? I'm not recommending anything. I'm just giving some different choices, yeah? So
this is a good slide, guys. Those who want to note down a couple of points, you know, Fundrise, Realty Mogul, you know, CrowdStreet, Equity Multiple. You know, some of those who have these questions do not know what is out there. Badri has done a good job trying to compile what are the best of the breeds in one place.
Exactly. And by the way, if you want to download the presentation, you could go to the Avestor Inc. website and you can download the presentation too if you want this. Yeah. So, and but be aware, crowdfunding deals can go south. I realize this is not what you want to hear in a syndication thing, but you have to be aware, right? So for example, we have invested in hundreds of deals. And when I say we, in Avestor and also our partners, one of the deals we invested in, Palm Springs, Hard Rock Hotel, what can go wrong? I mean, a good franchise, good location. the 17%, and we lost 100% of the capital. I mean, I don't want you to make it sound like we make no mistakes, right? There was a weak sponsor, Hard Rock revoked the flag on the property, and the lender finally took over the property. And one of the rehab and flip deals, the project took much longer, the sale price, there was no buyers, and ultimately it had to go to foreclosure. But the point which I want to make is this was one of our worst deals, and the maximum we lost was 6% on investor capital. So debt deals are relatively safe, and not to worry, not all our deals like this, but there are cases. So it's very important you look at the fine print, right? So here is the summary. Invest in real estate like stocks, build a portfolio to diversify and reduce risk. Look at, are you sure you're allocated across multiple asset classes? Are you sure you're allocated across multiple states? Private funds, equity, and debt deals provide a good way to expand your portfolio. So again, you have to decide what your investment goals are. I mean, is this your safe portion of your portfolio, or is this a slightly risky portion of your portfolio? You have to say, I don't know, where do you have your money, in stocks or bonds, or does your job already, you have a job in commercial real estate? Then you don't want to expose too much of your portfolio to commercial real estate, right? Research the investments, make sure it aligns with your cash flow needs, build liquidity into any plan. Crap happens, pardon my language. I mean, don't always assume you'll never need money 2 years from now. So always build liquidity into any plan, and always consider taxes. And crowdfunding can accelerate portfolio building, but please be cautious. Yeah, I mean, they don't fall for the pretty materials.
So, Badri, if you don't mind, maybe I can take 2 minutes just to talk about just small.
I actually want just 5 more minutes.
Okay.
Yeah. This was the educational portion, and I just want to briefly talk about Avister. Yeah. So.
No. What I wanted to do is basically I want to talk about my thing, and then you have time for.
Oh, okay. All right. Go ahead.
I'll take only 3-4 minutes. I wouldn't.
Okay, no worries. Yeah.
It was not planned. It just something came to my mind. I thought, let me share what I have.
Okay.
Just for 2 minutes, not much. So, guys, again, thank you so much for joining. And the real portion of Badri's presentation will start in about 2 minutes. That's what we called him for. So far, he was just talking about the education part, but now he's going to talk about what Avestor is and and what it can do for you. But before he gets into that, I just wanted to bring to your attention, there was a deal that we had closed last year in July. This is a 455 unit deal in Huntsville, Alabama. This was a heavy lift, and we have been doing pretty good on that. The goal was to exit from that deal in about 3 years. And we are at a point, basically where we are doing some refi. And we had not raised enough money initially. We had closed the deal. We had not raised what we had to raise. I mean, right now we are doing the refi, and the refi, we need a little bit extra capital. And again, we are not raising it. This is a 506C deal, so I can openly talk about it. Our returns were pretty significant, and they are still looking the same. If you see, equity multiple for a 3-year deal was about 2.55. Huntsville, we are already getting offers, but we are not ready to sell it. We have done approximately 50% of construction on the deal. And for next 1 year, our goal is to at least get to like 75% construction complete, and then pass the deal to new owner to achieve so that they can take it further. So right on this screen, I don't know which screen am I? You see the Excel spreadsheet, right? But do you see the Excel?
Yeah, I see the Excel spreadsheet. Yes.
So I don't have a presentation or anything, and that was not the intention of this webinar anyway. I'm just bringing it to everybody's attention that there is a deal out there. We are just not even raising this, only 300,000-400,000, and we already have that money. But since we are talking, I said, let me just share the deal with everybody. If we put in money now, our equity multiple still remains the same, but our IRR becomes pretty high. If you see here, and I don't want to lure anybody in any way, but our IRR is looking too high. In my mind, it is at least 35 to 40% easily, even though our model says it is about 65%. But if we invest a little bit of money, and we don't need too much money in it. Right now, we probably need 300, 400, 500,000. And it is not open. It is not advertised. I'm just telling it to a bunch of my friends. I mean, whosoever I told, I mean, they just like rushing to put the money in, and I'm going to put my money in also, as I said. But if anybody wants more information about this deal, 455 unit deal in Huntsville, Alabama, which was bought at a very low cost basis, about $29,000 a door. Right now, deals in Huntsville are going $70,000, $80,000 a door.
Hey,
So
Prashant, go ahead and send that information to me also. Avister will look at it. Yeah.
I
Okay.
will, I will, I mean, we don't have to raise money, actually much money, too much money, because we had closed it last year, right? We raised 4.7 million last
Uh-huh.
year. And right now our need is only like anywhere from 300 to 500,000 just to fill up the gap for doing the refinance.
Okay.
And that money is also there. I mean, I will invest my money, other partners will invest their money, but I'm just bringing it to the attention for those who want to come in. But this is open only for accredited investors. The minimum can be 50,000, because we need only 500,000. We want to give an opportunity to as many people as possible. I would say maximum would be 50,000. I mean, I would say 50,000 chunk is good enough, I think. If somebody wants to invest 100, that's a different story. But this is a pretty decent deal. I'm not told this has not been advertised, will not be advertised at all, and I'm pretty sure we'll just fill it up in a day or two. It is not open for anybody. Um, but because I had this presentation webinar today, we are going to close in about 2 weeks. We're talking to the lender. Um, Pretty decent deal. I mean, I have all the information. I can share the information. You have my email address, Prashant at myrealtygains.com. Feel free to shoot me an email, schedule an appointment. Uh, I will leave my basically I will leave my calendar link here. Uh, yeah, that's all. I just wanted to bring it to your attention. So Badri, all yours.
Okay. Thanks, Prashant. Appreciate it.
Yes.
So,
Yes.
okay. So basically, again, I won't take too much more of your time, but I just want to tell you about Avister. So Avister is a real estate investment platform. The key thing is this builds on the talk which we gave. Okay. So we build a custom real estate portfolio based on your risk tolerance. And so based on that, we diversify it across multiple states, different types of properties, and we also look at your liquidity time horizons, and we build a portfolio to meet those needs. Yeah. So the way it works is we pre-evaluate, just like I talked to Prashant now. We'll look at his deal, and if it passes our criteria, we have a mathematical model, and we invest our own money in the deal. Avestor is a private fund which invests their own money, and then we customize, and investors come along, and then we build a diversified portfolio, as I indicated, different asset classes, student housing, multifamily, retail centers, and a wide range of asset classes. And then this is completely transparent. Okay. For $50,000, you can build a portfolio of 25 plus deals instead of just putting it in one deal. I mean, if you're very comfortable with the deal, nothing wrong with going with one deal, of course. Think of us like the fidelity of real estate. You log in, it's completely transparent. You'll see how each deal is doing. And then you have the flexibility to withdraw the money as the money comes out. And then all of this is packaged in a single partnership structure. And this is huge. Like I told you, the K1s, in multiple K1s, you cannot offset passive income from one against another. But all of this is packaged in a single LP. So you get a single K1. We have spent hundreds of thousands of dollars in developing this platform. And you get a single K1 where you can offset passive gains from one against another. Yeah. So, so again, to recap, the way it works is we research the deal, we pre-invest in the deal. These deals are split into small slices, and you come along and set your overall portfolio direction. Think of this as you go to an investment advisor and say, I want 60% stocks or 40% bonds. And then you put $500 to $5,000 or $10,000 in a deal, depending on what it is. and then you get a pro rata share of the earnings, and you can either withdraw the money or you can reinvest in the deals. And as far as we know, this is the only platform in the country which gives commercial debt, residential debt, and equity deals in the same platform. Yeah. So let me just give you a very quick demo. And this is our website, by the way, avesterinc.com. And I'll just show that to you. So when you log in, again, think of us as the fidelity of real estate. You kind of see the account balance, the number of deals, and this is the return on the deals which have exited. We have not exited any equity deals in this portfolio. These are all debt deals. And then you get this nice little map, and you click on anything, you get more information. This shows how your deals are distributed across multiple asset classes and multiple states. And this is the performance summary of all the deals which have exited. And then this is your liquidity graph. It tells you approximately when you get your money back. Okay. Obviously, this is not like a CD. You're not going to get, it's not 28th October 2021. It tells you when these deals approximately exit, right? And so then if you go to the portfolio details page, again, this gives you a much more detailed accounting of each individual deal. So you can, for example, see commercial debt deals. Notice you're not putting a lot of money. You're putting $1,000 in this deal, $500 in this deal. This is a multifamily apartment. So it's exiting in 2021, 9.5% IRR. And let's look at some equity deals. You're putting as little as $2,500 in each deal. This is student housing, 18% IRR, not quite the IRR which Prashant has. But you get a diversified portfolio, and the exit date is 2023. And then this is, for example, a retail shopping center in South Carolina. You generally get the idea. The basic idea is we help you build a diversified portfolio, which is completely transparent. You get a single K1, and you can choose if you want, or you can auto invest. I mean, there are some doctors and engineers who are very busy and they just auto invest, or you can choose your deal. So that's kind of how it works. Any questions about this? And I'm going to type in my email, so feel free to reach out to me if you're interested in this. And there is a lot more information on the website, if I may go here. And the website is avesterinc.com.
So guys, in this industry, all of us work together. I mean, for all practical purposes, Badri is our competitor, so to say, but, we are here together. We want to create the right advice for everybody. And I mean, this is something which I haven't seen yet, right? I mean, for my personal investments, I was blown away when I see this, something like this, when Badri had shown me about a couple of months ago. But of course, I have different financial goals. But those who are like really busy individuals, they can have their auto investments. I mean, they can put their whatever small money, and they say, and keep it automatically reinvesting the money. Awesome platform, Badri. This is something, I mean, at least I have not seen it. I think you guys are the only one in the market who is doing this. Did you want to do some more demo, or that's all you have?
No, I'm happy to do more of a demo, but I wanted to respect people's time. So I just wanted to mention a couple of things. If you want to download this presentation, if you go to learn more and overview, we also have a short video of how this entire platform works. And there's a short video of how it works. And then if you go down below, you can download this presentation if you like. And a couple of questions. Somebody asked for my email or site. I did provide that. Carlos asked for my email and site. I did provide that information.
Yeah. Another question Lam is asking is, we get K1 because this is equity investment split over multiple properties, but grouped into one LLC. Is that the reason we get
correct?
One?
Correct. Exactly. Since it's in one LLC, but remember, it's not one size fits all. You don't have to invest in every single deal in the LLC. We have built literally we have spent hundreds of thousands of dollars in building the technology and the legal infrastructure behind this. And so we combine all of the K1s and we generate a single LLC, and based on how long you have been in that investment, right? I mean, so for example, you may come 6 months later. Unlike syndicators who have to close a deal before you move on to the second deal, sometimes you can get into the deals at different points because we take into the account the time value of money. So. And the other question about different states, you generally have to talk to your tax advisor. It's a single K1. Now, if generally the amount is not large enough to file in a particular state, I can't give you legal advice. You get a single K1, but whether you have to file a return in that particular state is something you'll have to talk to your CPA. Unless your amount exceeds the minimum significant amount, you don't have to file a return, but I can't give you that official advice. Yeah. So, yeah. So the way it works is that we have created multiple private funds. Each private fund can have up to 100 investors. I'm answering Lamb's question. So all of this is in a holding LLC. All the assets are in a holding LLC. Avestor Inc. is the corporate entity which invests in the technology platform. To be very candid with you, we have had a tremendous amount of interest in venture capital because we want to grow this very rapidly into billions of dollars of assets. So far, it's been self-funded. And so Avestor Inc., regardless of what happens to Avestor Inc., all the assets are included in the LLC, just like you would in a syndication deal. I don't know if I answered your question or not. So. And by the way, it's okay to unmute yourself and ask a question now. So
yes, guys. Yeah, because we are reaching towards the end of the presentation. If you guys have any questions, feel free to type them or unmute yourself and ask the question directly. That's okay. I mean, it's just that your voice will be recorded and it will be on the YouTube forever. So if you, I'm just kidding. So no, feel free to ask questions, guys.
Or the chat window is fine too. So.
Yes, no, I was just kidding. No, I was just.
Yeah. Yeah. Hi, Badri. Quick question. How do you calculate the risk for each investment type in a portfolio?
So we have various calculations. So when we come in, so what we do is we don't try to sell you an individual investment. We spend about 45 minutes understanding your risk tolerance, your liquidity needs, and then we ask you to come back, and then we build a custom portfolio based on what your risk tolerance is. So we have a proprietary model where we look at over 40 different variables. And I'm happy to share that information if you want to reach out to me. So let me do one thing. I will also put my calendar if anybody wants to. Sorry, I mean, you're seeing all this crap, so my apologies. But I'll just put my calendar link. So in case anybody wants to, you can. There is a private webinar link also. I'll put my calendar link in case anybody wants to set up some time to discuss how it works. So it's a little more complex question. Each deal is evaluated on its own merits. And then we look at and build a custom portfolio based on, say, if you're living in California, if you don't want exposure to California, we avoid that state. And then if you have some liquidity needs, if you say, I'm not sure, but I might need some money back in 2 years, we build that into the portfolio so that we select investments which mature in 1 year or less. You can't do equity deals for that, but we'll do debt deals. I don't know if I answered your question or not. So.
No, you have. I'll ask you more questions on the side.
Okay, sure.
So do me a favor, guys. Go to the chat window, do Control A. Control A will select everything and do Control C. That way you have copied all the contents, everybody's email. Feel free to share your contact information with others if you want to. But those who have shared, at least you will have that information with you. Control A and Control C, and then you can paste it in your Word document or in some editor. That way you don't lose this information, because when I close this meeting, it will be all gone.
Thank you. I appreciate that, Prashant. So,
and any more questions
from others? I mean, do you like the concept? I mean, I went pretty fast. Does that make sense? Thank you, John. I appreciate it. So again, the basic idea is to build a portfolio as opposed to doing one deal at a time. Nothing wrong with one deal at a time, but even when you do one deal, always keep the end goal in mind is all my feedback is. That's all.
No, I mean, pretty decent thought process. Pretty decent thought process. I mean, I personally do it differently because we have different. We are in a different mindset. We go deal at a time, and not one deal at a time. We go multiple deals at a time. From
Exactly.
a standpoint, it is different. Yes.
So one
Badri,
question I had was, what is the minimum investment? We keep the minimum investment very low, $25,000. But let me tell you, every single person who's invested in the platform has added additional money, every single one. So, but we keep it very low. Try it out. Put $25,000. For $25,000, you can invest in. We recommend 50, but you can always invest 25. And for even 25, we put you in 10 or 15 different, or even 20 different deals, depending on you're doing debt or equity. So.
Badri, this is Nara. A quick question. What type of internal controls and financial, audit controls you guys have in place?
When you say financial controls, all of our things are audited. And when you log in, you will see precisely what happens, right? I mean, so if you look here, I went through very fast. You can actually see what earnings have been allocated, and you can see what your earnings are for each specific instrument. If you're asking, and all of these assets are in the LLC, is that to answer your question?
No, yeah. I mean, I was just trying to see what kind of governance and controls you guys have that will secure, obviously, the investor,
Right, because all the assets are in the LLC, and it's independent of Avister, regardless of what happens. We have invested hundreds of thousands of dollars in Avister. And the other thing I should mention is every single deal in Avister, I personally put my money, and I'm a member of the LLC, and you're a member of the LLC. So, and I think it's a little more complex question in terms of what protections you have. I encourage you to talk to me more offline if you don't mind.
Yeah, sure.
The one other thing I wanted to mention is somebody asked, can you do a self-directed IRA? Absolutely. There is an entire section on our website. We work with two large IRA trust, Millennium Trust and Madison Trust. And, I'm happy to answer any questions. Yeah. So if you go to learn more, there is a lot more information. And also, I want to point out comparison to alternatives, right? How does this compare to investing in individual deals? How does this compare to investing in REITs? There is a fair amount of information on the website. We have got very good feedback on the website. So.
Yeah, so all the investments, whether it is syndication or REITs or Avestor, as long as you are passive investor, you are not part of a management team, you are not a general partner in a deal.
Correct.
You can invest from your solo 401k or from your self-directed IRA without any problem. They are always opportunity. I mean, that's one of the vehicle that we have. There's so much money present in self-direct, in IRAs and in 401ks. That money can be invested easily into real estate deals, or for that matter, in any other deals through self-directed IRAs or solo 401ks. So that's available irrespective of syndication or Avestor or
any other. Thanks. Yeah. So there was one other question. What is the cost? So for portfolios above $100,000, we charge 1% annually. For portfolios below 100,000, we charge 1.25% annually. I mean, every investor we have talked to feel like the value of the proposition, just the tax savings and the diversification more than pays for that. Yeah. So
1% of the portfolio value, is that correct?
Portfolio value, exactly. And every penny which comes from the investment goes to you. We don't take any share of the investment. I mean, so it's completely transparent. It's prorated, and every penny from the investment goes to you. There is no management fee beyond that 1% or 1.25%.
So in terms of evaluating a deal, I would ask a question from a syndication perspective.
Okay.
When you invest, when Avestor invests money, when you are evaluating the deals, what are the criterias? I mean, how much do you invest in one deal at a time? Do you go in as a private equity, where you take the whole chunk of equity needed on the deal, or you just invest like a little bit in the deal? How do you guys, what do you guys do?
Yeah, good question. If you don't mind, let me show you the one slide. So we invest anywhere from $25 to $100,000 chunks. And as we grow, we probably will increase the chunk so that we get a diversified portfolio. We may increase it to $200,000. And so to answer your question, I'm sorry, I have to bring up this longer presentation, but I'm not going to go through it, just one slide. So we look at a variety of factors in evaluating the deal. We look at these are some of the factors which we mentioned already in the general presentation, right? I don't know if I'm answering your question, Prashant, but we look at the location, obviously, the exit date, how attractive the location is, the target return. We even do a social injustice assessment, because sometimes we don't invest in mobile home parks because there's sometimes many of the syndicators take advantage of them. We analyze the capital stack. All of this is a mathematical model. It's not based on people. All these variables go into a mathematical model. We evaluate the deal. Then we look at the hurdle rates, look at the tier structure. Is it investor friendly or sponsor friendly? We look at this debt servicing risk, the top line revenue, the operating income, all the things which you would do, I'm sure you teach in the class. The sponsor risk, the track record of the sponsor, exits, the number of years they've been in business. And if it's a retail kind of a thing, customer risk, is it single renter dependency? Is it highly diversified? And if it's a debt deal, we'll look at the foreclosure. And all of this goes into a mathematical model and it spits out a point system. And that's when we decide to evaluate a deal. That's how we evaluate a deal. And we invest between $25,000 to $100,000 per deal and slice it. But as we grow larger, we probably will increase it to $200,000.
Got it. Okay. No, very nice point, because I mean, syndicators like me would like to know, if you have to invest something in our deal, how much is the potential that you would invest in? Because typically our deals are larger, right? We have $4 to $5 million raise.
Right.
100 to 200,000 does attract us, but we typically would go to private equity to get a bigger check if we have to do that.
Well, as we grow, our probably deal size will grow too, right? I mean, so as we grow, we probably will be increasing the deal size. But we also want to maintain a diversified portfolio for our investors, right? So that's the whole point here. So.
No, absolutely. Understood. Well understood. All right. Very good, guys. We are 4 minutes above the hour, and I know a bunch of you have to run to the debate that is going on.
There you go.
But no, I appreciate, Badri, you taking the time and explaining what you are offering. And again, as I said, I have not seen anything like that before, and I'm pretty sure at some point I will look into this and maybe invest in it. But guys, feel free to reach out to Badri. You have all his contact information, and you have my information also. As I said, we have a passive investing course. I have kept the link here in the chat window. Feel free to subscribe to that. You need more information on syndication. We are willing to share any and all resources that we have with anybody, whether you know us or not. We will share anything to bring you up to the speed on deals, passive or active, whichever way. We are very active in the market and in the social media. We do multiple deals in a year in the multifamily space, assisted living space, probably in mobile home parks also in future. But once again, thank you so much all, and a very good night to all of you.
You too. Thank you.
Oh,
Thank you, Badri.
Badri and Prashant.
Good press.
Yeah.
Good presentation.
Thank you very much, guys.
Thank you.
Appreciate it.
Bye.
We'll talk
Bye.
soon.
Thanks, Prashant. Can we chat for just a minute?
Problem. Thank you so much.